Wildcat strikes in South Africa's Platinum Belt have entered a 6th week with no resolution in sight. The rand has tumbled, insurance against default on South African debt has risen, and foreign investors have sold shares in mining companies. Now, since November, the country's outlook has been downgraded to negative. Earlier, Arabile Gumede spoke to Melanie Brown, Managing Director at Global Credit Ratings, for a look at the effect of the mining dispute on South Africa's credit rating.
Currently we're BBB+, negative outlook, and the next step from there would be a downgrade, and that would be negative for South Africa because what it's saying is that the risk has increased. So any borrowings that South Africa want to, or current borrowings as well as borrowings going forward, will be priced at a higher interest rate. And that would be negative.
And what do these strikes then actually mean for South Africa and actually the outlook and economic outlook on South Africa?
This couldn't have come at a worse time. We're already challenged by what's happening globally. About a third of our exports are to the Eurozone. So the uncertainty there and the reduced demand in those markets has had an impact in terms of our export volumes. So already the economy is under some pressure. So what is happening in the mining sector is clearly having an even greater impact. But I think it's a short-term impact. We've seen this before where we have this type of unrest, and hopefully sooner rather than later it will be resolved. The data for the sector will obviously be quite poor for the third quarter, but hopefully things will pick up by the fourth quarter and we will move forward.
And then what do you see? I mean, in terms of then government's response to this, how important is that actually to the big scheme of this rating?
It's actually very important. The international rating agencies, all three of them have identified essentially two issues. The first is political risk, and the second is policy uncertainty. So, and they go hand in hand. Any changes, they're under the impression that there's a significant amount of external pressure on policymakers. They call it the populist pressure. So what is happening now is an opportunity for the government to demonstrate that they will take decisive action against the illegal strikes and the unrest, and that anything that is happening outside of the economy, or in terms of what's happening on the ground, won't have any impact on policy decisions that have been taken, and they will remain firm. And any decisions or policy changes that are implemented will be based on economic landscape, as opposed to what's happening on the ground.
But now, is that the only way? Can consumers not, force some sort of measure or way to sort of create a better outlook, so to speak?
On the rating?
Yeah.
Not really. The rating speaks to the deficits, to debt ratios, and policies that are implemented in terms of growth and reducing unemployment. So it's really about those policies and decisions that are being taken at the higher level that will feed through down into the economy.
Now, obviously, I mean, later this year we have Mangaung, which comes heavily into play. How much do the policies that come out of there sort of impact this rating as well? Will that be able to bring the rating up or down as well?
It's not so much a policy that will come out. It's more obviously what happens at Mangaung in terms of the elections and any type of leadership change. You would expect the rating agencies to be a bit nervous. So the waters are somewhat cloudy at the moment, and it would be the same for any country coming up to a potential change in leadership. There is uncertainty, and that rating, that negative outlook, is a warning. So whatever comes out of the Mangaung conference and subsequent in terms of the policies and anything that the government does will be watched. And what we want to see ultimately is some form of policy stability, and as I said, any changes would be as a reaction to what's happening in the economic landscape.
Now, I mean, obviously, this also, deters South Africa in not being able to, to raise the correct or the right amount of borrowing costs, and perhaps we pay more interest with that. Then, how much more does that mean actually for our current account? What does that actually do for our current account then?
It would be negative. Ultimately, your outflows are greater than your inflows, so your deficits will deteriorate.
So I mean, obviously, then we're facing one of those tough times where South Africa really needs to stand up and stand firm. Then, what do you think is the right situation to come out of South Africa for either for the rest of this year to ensure that this rating downgrade doesn't come about?
We need to see, I think, a lot more clarity. A lot more certainty.
Clarity in terms of policy or in terms of political stability?
Well, that's the biggest, I think probably the biggest challenge right now is that in many instances the politics is being, or rather the policy decisions are being overshadowed by the politics. And again, it's because we're coming up to a potential change in leadership. And with that, there's obviously concerns. And as I said, the water becomes a little bit cloudy. What will happen? Will policies change drastically? Will decisions be taken that are not factored into that BBB+ rating? So any changes to policy that are not reflective of a BBB+ rating will have an impact on that rating.